is a short recording on transfer pricing and interest on shareholder loans and related matters, but with a specific focus on or in Africa. So the idea of this little discussion is to just raise a few points on certain issues that have come up in recent matters and in certain tax inquiries from revenue authorities in certain parts of Africa. What I can say is, this is not South African related. This is specifically other African countries. The reason why they say that is because South Africa has got quite a sophisticated level of tax and specifically focusing on transfer pricing, but in many other countries in Africa, they are starting to pick up and to get up to speed with certain principles that are laid out in the OECD Transfer Pricing Guidelines. So what I thought is appropriate is to just start with one or two specific issues that have come up over the years, and then also just to refer, and maybe I'll start with that first, refer to in the January 2022 OECD Transfer Pricing Guidelines for multinational enterprises and tax administrations. There is a new section that has been introduced, Chapter 10 or Chapter X, which says transfer pricing aspects of financial transactions. And in that section, under paragraph B, there is specific reference by saying interaction with the guidance in section D1 of Chapter 1, which has got to do with some of the basic principles of transfer pricing. And then it says here, determination of whether a purported loan should be regarded as a loan. Then you go into B2, which is identifying the commercial or financial relations. And then you go into section B3, which I just wanted to stand still for a moment, which says the economically relevant characteristics of actual financial transactions. So under that section B3, there are a few headings. And I just want to read the introductory part and then just mention one or two of those specific headings. It says here in paragraph 10.21, to inform an analysis of the terms and conditions of a financial transaction as part of the accurate delineation of the actual transaction or seeking to price the accurately delineated actual transaction, the following economically relevant characteristics should be considered, with emphasis on economically relevant characteristics should be considered. First one mentioned there are the contractual terms. And why that is also so important is because there you want to actually make sure that you understand what are the agreed terms between party A and party B. And you want to make sure that those terms are commercial. As we always say in transfer pricing, you want to make sure that the transaction is stated or delineated and priced accordingly as one would have had between two unrelated or unconnected parties. So in this case, your contractual terms are extremely important. Then you have a second point there, the functional analysis. Now, the OECD guidelines goes into quite a bit of detail on the functional analysis and what needs to be done. And it's quite important that one appreciates what those various points are. And there's references there to sections paragraph C11 and C112, which deals with credit ratings, the borrower's economic circumstances, as well as the lenders, etc., etc. So it's quite important to go into that. And then paragraph B33, characteristics of financial instruments, needs to be understood as well, and then your economic circumstances under which the loans are entered into. It rounds off with a very important other part, which also features in other parts of the guidelines, which is referred to as business strategies. And all of these aspects form an important part of where you start delineating and understanding the transfer pricing of financial transactions. So back to the topic at hand, where we want to just refer to one or two items or aspects of shareholder loans. So in the last few years, I've been involved and exposed to a few countries and a few matters in those countries. The one, I'm not going to mention the country specific, but what happened is that the Revenue Authority questioned the actual interest rate that was levied on a shareholder loan. And how they came about it is they just said that the interest rate on the shareholder loan is not arm's length, albeit that it is between two related parties. And they just said that the loan is too high, the interest rate. So what happened then is that during the process of the administrative as well as the technical analysis and process followed, and this matter ended up in court, what happened is that the Revenue Authority kept on stating that the interest rate is too high, but they did not offer any detail on what they're basing it, and they also couldn't state what rate it should be. And they also weren't able to provide details supporting their statement. So in the court case, what happened is that the client in this case produced the TP study that was done at the time, and that information provided a very important role to the court at hand. And what happened is that the court then found that the specific Revenue Authority were not able to defend it. And what happened is that the court found that the client's interest rate was satisfactory. They did not state that the rate should be higher or lower. They did actually not go into the merits actually of the actual rate. What they went into were the merits of the process that was followed. And that's why it's very important to appreciate some of the points which I just mentioned a short while ago, which is in the OECD Transfer Pricing Guidelines. So why I'm mentioning this is that one understands and respects the process that needs to be followed when you are dealing with transfer pricing on shareholder loans. Secondly, in a total unrelated matter, what happened is that the original matter started from a capital gains analysis or query and an assessment. And what then happened and transpired from that is that the capital gains assessment or matter then was quickly dealt with. But what transpired from that is, after an analysis of the information provided to deal with the capital gains tax query, the Revenue Authority then later stated that they believe that the interest rate is also too high. The client then produced certain information to state and support the evidence, which ranged from government bond rates to secure debt positions with non-related parties in the same entity. And that information, which is currently being considered, is being considered by the Revenue Authority to see if they agree. Now, why I mention both these matters is that clearly one can see that the Revenue Authorities do question interest rate percentages, and they also do question the actual interest that is levied. And there are certain consequences in both these matters, because in most African countries, you do have indirect taxes like withholding tax, and that withholding tax also plays a role in how the interest is to be allocated and calculated. And one needs to make sure that that part of the issue is also dealt with. So all in all, what we ended up with here is that both matters relate actually to transfer pricing on shareholder loans, and very specifically on the interest rate levied. What I can also say is that in studying these matters and dealing with these matters, it has become quite apparent that there's certain preventative measures that one should consider taking into account when you enter into transactions, and specifically in various, let's say, group entities. Firstly, very importantly, it's documentation, and archiving documentation is very important. In the one matter, it went back approximately 4 years back to the year when the matter was raised. In the other matter, it's also 4 years, going on 5 years, on which the subject matter is being questioned. The reality is that you could end up not having the employees still involved in those companies, and you will also have a problem in ensuring that you can get the relevant support in terms of the paperwork supporting the transactions, why they were set up. So this plays a very important role. The second important point, which might sound like a very odd statement to make is that don't assume anything when it comes to transfer pricing. So what is meant by that is that one must always go and break up the transaction and explain it thoroughly in all paper or objections or appeals that are lodged with the court or with revenue authorities, so that nobody misunderstands the information provided. Why this is important is many revenue authorities in Africa do not have strong or technical transfer pricing units. They are ramping up and getting the necessary skills on board. And for that reason, you end up dealing with tax authorities that do not follow, let's say, good or acceptable practices when it comes to transfer pricing. The other point, which is also important, is the administrative process in dealing with the transfer pricing matter. It's always important to understand the administrative process and understanding if there are special returns that need to be filed and that you've got the necessary evidence for those filings, and that you can provide evidence of all the information submitted over time. So I mention all of these points to assist people and companies and clients to ensure that in future, when they actually are setting up structures or attending to certain internal or related party transactions, that they ensure that they take cognizance of these various aspects. Lastly, I would just round off with one important point, which I do think will help, is certain companies in certain sizes of them do have what you would call an audit and risk committee. But what is becoming more and more relevant and a requirement as one deals with multinational groups or large groups is that one should consider actually creating a tax risk committee, so that that committee can get a certain level of authority in the group, and it will assist in the company dealing with any matters in future. So I wish you well and good luck with your transfer pricing audits on shareholder loans in Africa.